Welcome to the Block 3, Investing in Fixed Income Securities. In this section, we are talking about the special features of a bond issue, namely the call feature, the sinking fund, and the bond rating, as much as secured or unsecured bonds. Now let's start with the call feature. Many bonds nowadays are issued with these kind of call features, which gives the issuer of a bond the possibility to retire a bond before maturity. So when the official maturity date is 2030, the bond issuer can retire the bond, for example, in 2025 already. He's doing this because he believes in an advantage, especially when he believes that the interest rates are going down or the interest rates are lower than the coupon rate of the existing bond. Then he is willing to exchange a high coupon bond with a low coupon bond, and for that decreasing the cost for the financial liability. Within the call features, we have to differentiate that three areas. First of all, the non-callables. The non-callable bonds does not have a call feature. So here it's prohibited to call or retire the bond before the maturity. Then we have a deferred call feature. Here the bond issuer has to wait a certain time, sometimes 2 to 5 years, until he has the right to call the bond. So this defers basically the possibility to call it. And then we have the freely callable bonds. Here the issuer can call the bond anytime he wants. We already talked about that the issuer of a bond only is doing this when he has the benefits, mainly if he can issue a new bond with a lower coupon rate than this existing bond which he wants to call. But any call feature comes with cost due to the fact that the bondholders are not able to hold the bond by the end of the maturities. They're facing lower returns because a bond will be called earlier and the reinvestment would be then with lower rates. For that, the bond issuers needs to pay a so-called call premium. A call premium is that what is added to the par value of a bond when the bond is redeemed or called. For this, the call price is the par value, for example 100, plus the call premium, for example 5%. So the call price is 105%, being a premium on that. It is important to know that there is a protection provision in the bondholder statutes. That means that the issuer of a bond is not allowed to cover the cost, the call premium, with a new issue of a bond. So it has to be paid out of the cash flow. Now here we see the 38 bonds in US dollar, and we have here the feature of yes. And if we want to see whether the Apple bond is a callable, we go into the details of this bond. Being in the detail, we are scrolling down and look whether this bond is really a callable, and seeing here in these, yes, it is a callable bond. Unfortunately, it doesn't show when it's callable. For this, we need to get the statutes. Another special feature of a bond is a sinking fund. The sinking fund stimulates the issuer to pay off the bond over time, and this is only possible for term bonds. When we look on the right side of the graph, we see here a typical 10-year bond which is issued $1 million US. It has a maturity of 2017 to 2027. Most of the sinking funds requires that the sinking fund starts 1 to 5 years after the date of issue. In our case, it starts with the 5th year. So over the first 4 years, the 1 million issue is on the market. After the 4th year, meaning in the 5th year, the company starts to redeem, pay off 100,000 of the bond every year. At the end, the company is paying or retiring the outstanding amount as a balloon payment, meaning fully. So at the end of the 10 years, the whole bond is retired. Another special feature is whether the bond is a secured bond and unsecured bond. Senior bonds are in general secured bonds, meaning here the claims of the bondholders are backed by any legal assets, most of the or property by the issuer. Here we differentiate the mortgage bonds. Mortgage bonds, most of you probably know that, is secured by a real estate. Real estate could be either a building or a land or a combination of both. Then we have the collateral trust bonds, which are secured by financial assets, stocks, bonds, mutual funds, which the company holds as an asset. And these are owned by the issuer, but held by a trust company. Then we have equipment trust certificates. They're secured by specific pieces of equipment, especially airlines having the planes as an equipment trust or as an backed assets or boxcars. First and refunding bonds have a combination of first mortgages and junior lien bonds, meaning here the securance is the mortgage first and then third mortgages, meaning at the end where the owner of the mortgage has only the third part of the asset. The opposite of the secured or senior bonds, we have the junior bonds, which are also called debentures. Here they are totally unsecured. At the end, it's only a promise of the company who issued the bond that they're paying interest and principal back to the owners. Here we have three alternatives: the debentures, which are totally unsecured bonds, meaning there's no collateral backing these obligations. Then we have the subordinated debentures. Here their claim is secondary, meaning first the debentures are paid interest and principals, and afterwards the subordinated debentures are getting the money. So the risk is even higher here. Last, we have the income bonds. So these are the most junior bonds. They're relatively close to the equity with the risk concerns, meaning here the payment of interest will be only done if a certain income is earned by the company. Now we're coming to the bond rating. The question is, how can I see the risk of a bond issue or of an investment in a bond? For this, there are agencies on the market, mainly known as Moody's, Standard & Poor's, and Fitch, which are regularly rating these companies which are issuing bonds on the market. Most of these ratings are done by letters, which we see on the next slide. In the comparison of Moody's and Standard & Poor's, we see that they use AAA, AA, though there is a letter priority from AAA down to C or single D with the risk concerns. At the end, it means the better the rating, the lower the risk. The highest rating would be AAA. The lowest rating would be C, respectively D, from Standard & Poor's. Now, how does the bond rating works? A firm's financial strength and stability is very important to determine that. Meaning the cash flow is important, the earning streams is important, the liquidity of the company is important, and certainly the forecast of whether the company is able to promptly pay interest and the principal back to the bondholders. The better these possibilities are, the better certainly at the end will be the rating of the company. When we look closer on the ratings, we make the differentiations between an investment grade and a junk bond. As you can see on the picture on the right side, the investment grades are all these bonds which are rated between AAA and BBB. So these are relatively safe, conservative, lower risk bonds. Everything which is below BBB, meaning below the red line, is then called a junk bond. Junk bonds are below investment grade ratings, and these are from companies they are lagging in the financial strength. They are higher risk. We also call them speculative issues. Since we have Moody's, Standard & Poor's, and Fitch, we also can have split ratings. Split ratings would be the ratings of 2 to 3 of these rating companies. And certainly that could be different at the end. Important for the companies in general is to get closer to the investment grade, because the higher the rating is, the lower certainly the cost of the bonds are. Meaning, if I'm in the investment grade, I offer the bondholders lower coupon rates than being in the junk bond area. And that means I can decrease my financial cost of bonds if I'm able to come up or be upgraded to investment grades. Vice versa, certainly, what the downgrade concerns, if I get downgraded to the junk bonds, I need to offer higher coupon rates. Good. So now you're aware about the rating of a bonds. You know what the call features is, the different call features. We talk about the sinking funds, the possibility of the company to decrease the outstanding issue partially over time. And you know the difference between senior and junior bonds, secured and unsecured bonds.